Technical analysis. Technical analysis is based on the idea that market trends, both short-term and long-term, can be identified and exploited by analyzing charts, price movements, and other indicators. This type of analysis is commonly used in the stock, forex, and commodities markets. One of the key principles of technical analysis is that market trends tend to repeat themselves over time. This means that patterns and trends that have occurred in the past can be used to predict future price movements. Traders who use technical analysis will often use charting software to analyze price movements and identify trends. There are several different types of indicators used in technical analysis. Some of the most common indicators include moving averages, which show the average price of a security over a specified time period, and oscillators, which are used to identify overbought or oversold conditions in the market. Another important concept in technical analysis is support and resistance levels. Support levels are price points where buyers are likely to enter the market, while resistance levels are price points where sellers are likely to enter the market. These levels can be identified by analyzing charts and looking for areas where prices bounced off a certain level multiple times. While technical analysis can be a powerful tool for traders, it is important to note that it is not a foolproof method for predicting market movements. Traders should always be aware of the risks involved in any trade and use technical analysis in conjunction with other forms of analysis to make more informed trading decisions. Technical analysis is a method of evaluating securities by analyzing statistics generated by market activity, such as past prices and volume. The goal of technical analysis is to identify patterns that can be used to predict future price movements. Traders who use technical analysis believe that market trends, both short-term and long-term, can be identified and exploited. This is done by analyzing charts, price movements, and other indicators to determine which direction the market is likely to move next. Technical analysis is often used by traders who are looking for short-term profits. It can be useful for identifying entry and exit points for trades, as well as for managing risk. However, it is important to note that technical analysis is not a foolproof method for predicting market movements, and traders should always be aware of the risks involved in any trade. Overall, technical analysis is a powerful tool for traders, and it can be used in conjunction with other forms of analysis to make more informed trading decisions. Thanks for watching.